You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
Big thing is critical metals are still taking away a lot of our thunder here in the gold space. People are still excited about that, and but I did hear from some that generalist investment funds are starting to get interested. They got that at the BMO conference, which was right before the PDAC conference.
Welcome back to Mining Stock Education. I'm your host, Bill Powers, speaking today with David Erfle, the Junior Miner Junkie. Junior Miner Junkie with a Y.com is David's website. He runs a subscription service, a teaching service for investing and learning about how to invest in junior mining stocks. David, welcome back onto the program. You were just in Toronto, but now you're back in California, a little warmer where you are now. You were there for the PDAC conference. That's the world's biggest mineral exploration conference. 23 to 24,000 people were there. Tell us about the vibe. What did it just feel like an industry conference, or did it have kind of a feel of an investment conference? Was retail there and excited?
I didn't see a lot of excited retail. There was a lot of youngsters in the crowd, but that's usually students. But the attendance was pretty good. 24,000. In attendance. That was good. On Sunday, it was kind of dead, which it usually is. On Monday, it was really packed. And then we're thinking, wow, it's the vibe is good. It's, people are excited. But the big thing is critical metals are still taking away a lot of our thunder here in the gold space. People are still excited about that. And, but I did hear from some that generalist investment funds are starting to get interested. They got that at the BMO conference, which was right before the PDAC conference. I didn't attend that, but I always like to talk to, my friends and colleagues to find out, what the vibe was there. A lot of meetings, a lot of corporate meetings, a lot of, buy-side meetings, a lot of capital market meetings. So, people are seeing the value. They're not ready to pull the trigger yet, but I think they're seeing the value. They're getting interested. They've made a lot of money in the critical metal space. If you take a look at the lithium chart, it looks like a huge top to me, along with the uranium chart. A lot of money's been made in that sector. While the gold mining stocks have been going down, those stocks have been going up. So I think there's going to be some rotation coming out of there pretty soon. And if you combine that, lack of interest going into the critical metals and some in uranium, and if you combine that with the generalist investor, which hasn't been in gold stocks in over a decade, basically, they left in 2013 and they haven't returned yet. That is transcribed into the most apathetic market I've seen in my 20 years that I've been in this sector. If you just take a look at the volume on the venture exchange, it's the lowest it's been since 2001 when gold was $250 an ounce, and it's just sector apathy. You see the smart money, the professionals, they see the opportunity, right? So they're starting to get interested. But it's just we need to have that generalist investor interest come back into the sector, because and I don't think that's going to happen until $2,000 gold has been a strong ceiling for over a decade. That needs to become a floor. We've had a weekly close, we had a daily close above 2,000 several times. We've had a weekly close above 2,000 a few times. We've yet to have a monthly close above. When that takes place, momentum chasers come in. They see the cup and handle. They see the huge, 12-year cup and handle chart on the gold price, and they're like, they'll know this is game on. Gold price is going to break out.
Hey, for the generalist funds that you were told are looking at this space, what are they looking at it as a value play, or how are they perceiving it?
They see what's on the horizon. They see the Fed eventually making a policy error, which they usually do. What the Fed is doing, they're basing what they're doing on lagging indicators, right? Jobs, inflation indicators. These are lagging indicators, and you've got such an aggressive such an aggressive rate hike program. This is the most aggressive rate hike program in over 40 years, right? So that takes a while to get into the system. That's lagging also. It takes about 12 months. So since they started, about 8-9 months ago, so that takes us into early summer where something could start breaking. Because basically what Powell said on Tuesday while I was at the conference, the PDAC curse again, where we get a big whack while PDAC's going on. What he said basically took a soft landing off the table. Aggressive rate hikes for longer than expected.
But you didn't buy into a soft landing to begin with, though. Right?
No, I never. Of course not. I mean, of course not. I mean, their 2% inflation target is pure fantasy. They'll be lucky to get it to 4%. So, just take a look at U.S. private debt to GDP. It's 280%. I mean, just the interest alone on the national debt now, which is over 31.5 trillion, is going to be 1.3 trillion this year. So they're going to keep raising rates until something breaks, which is what they do. And the gold sector is going to be a big beneficiary of that. They're going to have to, stop raising rates and then eventually reverse policy. And that's when, everything takes off in our sector. And that's when that'll probably be the catalyst for gold price finally getting over $2,000 and staying there. But what I don't want the catalyst to be, of course, is something very harshly geopolitical, like, something nuclear. Nobody wants to see that. And if that happens, gold stocks are going to get hit. All stocks are going to get hit, even though gold stocks are ridiculously depressed and there's just no interest. I mean, if you take a look at how they were selling off into what I believe was a major bottom in late September, and then they went up 55% in 4 months. The rollover now is taking place on much less volume.
Dave, how do you see copper? A lot of your gold companies also have exposure to copper. How do you see the copper price performing?
I like the story, because these copper mines are running dry, and we got to replace all this supply, and it's just not there. I get the big picture, and I do have 2 stocks that have heavy exposure to copper. But when this recession takes place, and I think it's going to be a stagflationary recession, copper could get hit. But I still like, the company that I have is the 2 companies I have are developers that have huge exposure to copper. Their value plays right now, very cheap. So, I've got the time, and, I don't trade on margin. So I can sit and wait.
And Dave, you have your exit strategy you've articulated in writing to your subscribers. Are you willing to share a little bit of your exit strategy for this cycle that you've already outlined?
Certainly, yeah. It's basically my strong belief is, it proves out in the history of the gold stock cycle since 2001. Gold stocks make major bottoms every 7 years, right? We had one in 2001. We had one in 2008. That was a V bottom. You had to be really quick to catch that one. And then we had one in 2015, which was more cumulative. And so I believe we had another major bottom in 2008 when the GDX corrected from its former peak of 60%. GDXJ, I think, was about 60%. But and then once we had that low, it came with with just everybody selling out of their gold stocks. It was obvious.
The low in 2022. I think you said 2008. Right. You meant 2020.
Right. Low in 2022. Thank you. Yeah, I mean, it was classic, capitulation ending to 2.5 year bear market, where everybody was just done. I'm done. I'm throwing in the towel, right? And interestingly enough, the peak in 2016 that happened from the late 2015 low, that was just a 6-month bull market. And that's the interesting thing about what's happened in the past decade. We basically had 6-month bull markets, and we've had 3-year bear markets. But I digress. So the move up into 2016 was about a 300% move from the absolute low, and it took exactly 26 months to consolidate. Same thing happened in 2020, but the move up only took 4.8 months. It was about the same amount, but it came from a V bottom after the forced selling that came out of the pandemic panic. And that took exactly 26 months to consolidate. So that's into September of 2022. There is an open gap that's a little higher. And I left it on the table for my subscribers. I've been warning them that, hey, there's a possibility that this gap will fill. I don't think it will, but but it certainly might. Well, what's taken place this week, I think the odds have increased of that gap filling. And those gaps are at 23 on the GDX and I believe 29 on the GDXJ. So I believe there's a strong possibility those gaps will fill. But if you take a look at the volume on a lot of these juniors, there really isn't much. Some of them have already tested their September lows on a fraction of the volume that when they made those lows in September 22 of those capitulation lows. So basically, you just in this sector, when you're bottom fishing and you're accumulating at what you believe to be a major bottom, it's very frustrating. It's very difficult. It's very challenging. But if you know what you're doing, and this is the third time I've done it over the previous 7-year cycle lows. I did it in 2008 and I did it in late 2015. You could do very well, but you just can't use margin. You have to have tons of patience and you cannot buy strength.
A recent guest, Peter Grandich, warned me and my listeners not to put more money into junior mining stocks than we can afford to lose 100% of. Can you share with listeners how you're still playing with your initial capital? When you sold your house, took the equity and bet on these little stocks, you're still playing with that money, aren't you?
It's crazy. It's been a long, strange, wild ride. I mean, I put in exactly about $475,000 when I sold my house in the juniors, right? And I don't recommend this at home, please. And I didn't have any children. I was single. This is something I could afford to do, and I did really well. I tripled my money, in a few years, and the rest is history. I'm sure most people know the story. But the one thing, my one big rule is I never reinvest my capital gains. I always take them out and put them somewhere else. You start doing that, you start to get cocky and you start to basically lose your way. So that is a big rule of mine. And that's what's kept me in this game with that. To this day, I still have that much invested. 475 is what I have invested, and I'll never invest any more. And hopefully I will be forced to invest any less.
But you expect the 475 to go up at least threefold. That's your expectation.
Right. It's done so several times already. Yes. Mm-hmm. And each time I learned to take more off the table at the top.
Yeah, you got to keep money to stay in the game too, right? As
Absolutely.
They say.
Yes. It's an incredibly challenging sector, and it's incredibly technical. And I've been in it 20 years now, and I know a lot more than I knew back then. If I didn't known back then what I know now, I probably wouldn't have done it, because now I realize how basically ignorant I was back then.
Dave, on that point, I was having a conversation with a friend, and we were doing a risk reward analysis of a company we were looking at investing in. And then I pointed out that this person who's in the industry is ultra bearish and lifted up all the things. And my friend and I looked at it, and we had to acknowledge, we don't know what we don't know in terms of the risk, because we don't know this sector as well as this person did.
Exactly. Yeah. I mean, I'm learning something every day. Every minute of every day, I'm learning something, and I'm trying to pass that knowledge onto my subscribers. And I've learned from them too. I've learned a lot from them. I mean, and basically having, 300 or so people looking over my shoulder, it forces me to sharpen my pencil even more and work harder, because, the harder I work and the better I do, the better my business does, because my numbers stay solid. So, it's really a labor of love, and that's what I love about my subscribers and my service. It's kind of we're all in it together. We're all helping each other, and because we all got the same common goal, and that's to beat this incredibly challenging market. And
you're going to stick it out.
Absolutely, I'm sticking it out.
What happened? Because you have that threshold of 25% drop off. You have the sell point. What happened if it drops 40%? On I've got a few that are down 40%. But my rule is if I believe that the sector is making a major bottom,
then I don't sell after a 20% loss. My 20% loss rule is only during bull markets.
Mm-hmm.
You know, if I mess up my entry point, because, you know, basically you can make up losses really quickly in bull markets, but in bear markets, you have to be extra cautious, extra careful, and you have to accumulate on weakness. And the uglier that chart gets, you have to reverse your emotions, you know, and, you know, you get with that company and you make sure that they have the access to capital. You make sure they got the right project. You make sure that they're raising the money at the right times. You make sure that they've got just as much to lose as you do if the stock goes down. That's a huge one, you know, and that's always the first thing I ask companies when I'm talking to them, when I'm considering an investment. You know, how much did you pay for your shares? How much do you own?
That's a great point. And what I often point out to people about the junior mining sector, Dave, as you mentioned, like critical metals are stealing a little bit of gold's thunder here. Mm-hmm. But we like gold, obviously. But in junior mining or in commodities in general, there's usually always a bull market that you can locate. Because I remember this is my second lithium bull market that I missed, you know, because I was focusing on gold and silver. And I had some hedge fund managers tell me to avoid lithium back in 2017, 2018. Uh-huh. And I missed 2 bull markets in lithium because of it. But there's always opportunities at the same time. There's always risk, like we've lifted up, but there's always somewhere you can make money, even within junior mining.
There is. And, you know, and the worse the sentiment gets, the more excited you should get. It's difficult to do that. It's really difficult to reverse your emotions, you know, when everybody's running around saying, you know, the sky's falling and this sector's terrible and I'm selling everything. I mean, that's when you basically have to reverse your emotions and say, okay, where are the opportunities out there? And, you know, when the bottoms don't happen as a V bottom, you have all this time to make sure you're in the right companies. But when the V bottom happens, like in 2020, you got to make sure you have that watch list ready and you know what exactly you're going to buy, and you got to do it quick.
Yep. Great point. Well, Dave's website is juniorminerjunkiewithay.com. Go over and check that out. And he has a free Friday evening email that he sends out with his editorial, usually focuses on gold and the junior mining sector with an emphasis on gold. And he'll email that to you every Friday evening if you go sign up for his list. Dave, thank you for coming on the show today, and I'm glad you got back safely from PDAC.
Thanks, Bill. Always great talking to you.